Hey everyone, welcome to Options with Hans. I'm Hans Albrecht, your friendly neighborhood options trader. I was a pro options market maker for 15 years and options income fund manager for a decade after that, $1 billion managed. Please like and subscribe and grab my free ebooks down in the description. And if you do, today I'm going to also sign you up for my free 4-day options challenge course that's going to give you actual actionable ways to approach selecting great companies that are acting well and options that can help you to generate income legit. I don't do junk giveaways. You get the good stuff here. So, as always, this is for educational purposes only, your trade, your responsibility. And if you're okay with that, let's dig right into a little series called Monday Millionaire. That's going to delve into great companies, great stocks, and ways that we can use options to capitalize on that growth, generate income, and even for a hedge. Remember, I ran millions in downside protection funds as well as long equity with income. So offense and defense is the name of the game. Now, I think we could be entering into the next leg of a bull market that is going to be driven by AI, by tech advances, by improving profit margins, actually, by innovation. But I think it's going to come with some potholes and disruption on a scale that maybe we have never seen before. And that's an amazing thing to say, but I think there are going to be phenomenal impacts to businesses that thought they had these really wide moats, these real advantages for maybe years, even decades. We may even see some collapses in formerly considered very solid companies. So think of what happened to Kodak Film, and some of you are going, Kodak, what the heck is that? Exactly. They were huge. They refused to see what was happening, and now they're just a bit of nostalgia. So we're going to have our heads on a swivel as we navigate what I think could be an absolutely fascinating next few years that could be massively lucrative if we play it right. It's going to happen fast, and the next multimillionaire is going to come from this, and I am here to help. So let's do this. Today, we're talking about Robinhood, what I consider a fairly established player in the trading space, but what I consider a real up and comer because of its potential to disrupt, to move into all areas of the asset trading and wealth management business, right? It's a great business to be in because it's managing people's stuff, it's giving them tools, it's giving them ways to invest, to trade, and you grab the little crumbs from all the things that people are doing on a daily basis. So this company is very nimble. They are very smart. They are disrupting a large and largely overconfident business, right? This is not only is this industry kind of overconfident, it suffers. It can't help it. It suffers from this sort of sheer size that it has. Size can be great. You get a lot of those economies of scale and things like that, but it can also mean that you can't be as nimble. So you can't pivot as quickly as you need to when you're a very big company. And that's where you're seeing a lot of disruption. These smaller up and comers that are able to think quickly, use the digital world, and really listen to what customers want. So I think when you're investing in technology, you really want to have this sort of longer term view. And I know that sounds like a bit of a Captain Obvious sort of thing to say, but you really need to think, especially in these times where disruption is going to be massive with AI and quantum. My goodness, what's going to happen with quantum? You have to really kind of look down the road and say, is this going to be a thing in 5, 10, 20 years? And what I really like about this industry is everyone's always going to have money to invest, sometimes less, sometimes more, but this is going to appeal to the big younger demographic that just wants, kind of hip. It doesn't want it, it doesn't want its dad's stuffy old 3-piece advisor. It wants all the things that it's looking for. We'll talk about that here. So this great wealth transfer is going to be absolutely fantastic. So when I look at sort of long-term narratives, that's going to be a thing. There's no a way to avoid that unless everyone figures out how to live to 150. There is going to be this massive wealth transfer from an incredibly fortunate generation that has done well on assets, right? They have juiced up assets with low rates and all this stimulus. So houses and businesses and comic books and baseball cards and artwork and all kinds of asset holders have done really, really well. So this wealth transfer, to the extent what they're going to have left, which is plenty, it's going to be a massive trillions and trillions of dollars that is going to be inherited by this younger generation. So that's going to make things really, really cool for a company like Robinhood that wants to get you in early. And we'll talk about that sort of BMW comparison, sort of car series comparison. So, and if you look at this, is interesting here. 72% of millennial and Gen Z investors uh, believe it's no longer possible to achieve above average returns solely on traditional stocks and bonds. And I'm not saying that the big companies aren't recognizing crypto and a few things, but companies like this are being very, very nimble. I'll point a few things out in a moment, and they can move very quickly. Look at how people were betting on the election. Robinhood made that possible very, very quickly. Boom. They are listening to what people want. So very, very interesting times, and you need to have that really good outlook. So unlike these legacy financial institutions that sort of cater to sort of older, more traditional clients, those high fee models, right? High fee models are out with the younger people. These in-person people don't need to see anybody, right? These big bricks and mortar locations. There's so much upkeep. There's so much money to spend on keeping these places. The digital banks and entities don't have that. So Robinhood really appeals to a lot of things that those millennial and Gen Z users really, really want. Nimble, hip, cutting edge, mobile first, right? Everything they do is on their phones, is digitally. Low cost trading. They do not want to spend a whole bunch of money on trades, which not many people are doing anymore. But this is an interesting twist on things. Low cost trading, in fact, free to trade many things, although there could be some challenges from that order flow model. So, how does that work? Well, companies like Robinhood, TD does it, a few companies do this. Basically, they don't charge you anything or very, very little, and they sell the order flow to market makers, to the citadels. And so you're not always getting the absolute best price. And that's a little bit controversial, right? It makes sense, right? That's a kind of challenge for the industry as people bring more attention to that, which they have. Now, the good news for Hood is that used to be a very big part of their revenue, revenue, and it isn't any longer, right? So they keep diversifying away from this, so it becomes less and less important. So, plus easy access, crypto stocks, ETFs, tools for managing wealth. In a non-traditional way. BMW, what do? They want to get you in on that one. Do they have the 1 series, the 1 series, then the 2 series, 3 series, 4? They get you in early in your life, and they pull you along throughout all the different models as you make more money, as you gain more success. They want you in that ecosystem so that they can keep selling you things. That is what is going to happen with something like Robinhood that has a really nice lead in many of the areas that we're talking about. Once you get in there, you kind of almost have this barrier to leaving, right? Once you sort of get a lot of stuff going for people that they want, it becomes difficult for people to want to leave when they're getting everything they need, right? I'm not saying it's exactly like a massive, massive barrier to exit, but there can be a switching cost, and if you continue to listen to what people want, you're going to do well. So Robinhood launches presidential election, so that's kind of a cool thing. So the idea is that this is going to become almost the Amazon Prime of finance. You look at what they're doing with this $5 a month Robinhood Gold subscription. So think Costco, think these memberships that get you in, make you feel a little bit special, give you all these perks, high yield cash accounts, these interesting ETF portfolios that they put together for people, estate planning, tax planning. Investors want the whole package. They don't want to have to go here and there and everywhere to get different things. They want it all in one place. These guys are even making you feel special, super private banking style luxury perks like the cash delivery. They'll just deliver cash to you. So this is what they're trying to do. The goal is to really build loyalty, bundling those essential financial tools, those white glove experiences as you make your way up in the ecosystem of Robinhood. Just like Prime keeps people in the Amazon ecosystem, Robinhood wants to do the same, and they want to manage everything for you: investments, inheritance, etc. So, and investors, what do they love? They love recurring revenue. $5 a month, which I'm sure has some good pricing, some pricing potential as they move that up over time. That is beautiful, wonderful, delicious recurring revenue that investors love to hear. So, and it's working. Robinhood Gold subscribers more than doubled to 3.2 million people. So 100 million in annual revenue from that. That's great momentum in that area. That is part of the reason the stock has been um, reacting well. Robinhood isn't just chasing the retail traders, it's redefining what that financial loyalty looks like with all these great features that it offers. So, Robinhood also making big, significant bets on crypto, right? As a native kind of asset class that the younger generation likes, right? Commission-free trading, Bitcoin, Ethereum, Dogecoin. And then the acquisition of Bitstamp was a little Canadian exchange, not a big bet, $200 million. That is pretty small. But I like to see this company nimble and skating to where the puck is going, continually trying to move itself into the areas that it needs to in order to grow. Competitors, who's in the way? Well, we've got legacy, of course, the Fidelities, the Schwabs, the Merrill Lynches, Morgan Stanleys. In the fintech area, of course, no one's going to just sit around and allow for this to happen. But Hood has this amazing sort of brand that is building and building and building, and I love that. Right? I love Uber for that reason. I love the brands that just kind of almost create a lock, right? The Netflixes, no one's going to leave Netflix, for example. So you're just continually building that value proposition for people, and the bigger it gets, the stronger it gets, the more you have kind of a lock on that part of the industry. So, Hood wins. It's got the great user experience that just keeps getting better and better, and that's really what you got to do. It's all about the customer. Banking, of course, we've got those legacy names as well. Robinhood starting to offer that cash sweep where it'll put your cash into various bank accounts and grabbing high yield savings and things like that, which was a criticism of it for a while. Now they realize that they have to do that. So, and then trading and investing, of course, this is where they're really pushing, right? Fractional shares, crypto, zero commission, the platform could be a little bit better, I have to say. So hopefully they're going to improve things from the standpoint of people who really want to trade more actively. They're going to need to step it up a little bit there. Why Hood could win big? So they've got this massive user base in prime to inherit just $120 trillion or something like that over the next decade. So brand loyalty, terrific, first mover advantage in these bundling services, right? All the things that are important to people, adaptability, right? So the US election things. So they're just doing all the right things, and it is not an inexpensive stock, but they are doing fantastic things. So look at the financial highlights. I don't want to spend too much time. Let's get into some of the juicier stuff. But gross margins, 80%. Are you kidding me? Phenomenal. 58% year over year revenue increase. Just fantastic stuff here. Look at this. Robinhood average revenue per user just taking off, right? Even as they invest and spend and keep growing, they're already doing great. Trailing 12-month EPS just going in the right direction, right? Big turnaround for this company that had some troubles a little bit earlier. So a nice little chart of different things here. You can see this gross profit margin is just killer. Look at this, 86, 90, 91% gross profit margin. Free cash flow margin, very respectable. Net profit margin, and you've got that forward P. It's not an inexpensive stock, right, guys? So let's take a look at some technicals here. And this is a stock that's had a good run. I started trading it probably in the high teens, dipped down, bought some more, got out of a few positions here, but really started to add in the 30s, even in the 40s. It came down, of course, when everything sold off. We see these ATRs just exploding higher across all stocks in the market. Came down and touched $30 again. So I started loading up here around 34.80. So full disclosure, I do have quite a large position in this stock. And I have been flipping some things out. So bought some leaps down to here, flipped them out in the high 40s. unfortunately, before this big run here. So, but the idea with a stock like this for me is there are trading opportunities, but there's always going to be that core position that I really want to have. The problem sometimes with options trading is you kind of get stuck in the trees as opposed to kind of zooming out and looking at the big picture at the forest, right? The forest for the trees, and forgetting that there may be a larger movement in the particular name that you want to trade. So always try to step away and kind of look at things from a trading and perhaps even investing perspective, if that's your style, right? So if you're some people are just mostly trading and they just want to get in and out, and that's fine. You do you. So I like it here. We see it's coming back. It's basically respecting this 9 EMA, which I really love to watch as stocks are in a bullish trend. When they start to get into a bearish trend, I look for that 9 EMA as a place to maybe lighten up on positions, maybe add some cover calls. If the vol's high enough, look at put the call skew, and kind of maybe initiate some bearish positions or some hedges. So 9 EMA, very, very useful. If it gets below there and below the 20, then you start to wonder, right? So this is kind of no man's land here. So we come back still very bullish territory. Now, this is for sure. This is a stock I'd like to see a little bit lower. I love it. I'd like to be able to add a little bit more as it comes off. So this is the kind of thing, if I didn't have a position, I would be looking at initiating an initial position, a starter position, and then hoping for maybe a little sell off into the low 50s here. As you can see, there's a big spot here where we had a bit of resistance down to 30, resistance again, got through this traffic jam in here, and then really exploded to the upside on fundamentals and, of course, on a broader market rally that we've had. So very, very nice stock. We have this in our Leaps portfolio, which I haven't hedged. I just kind of keep that in there. And it has been, I think it's been our best stock of the whole bunch. And I have Netflix and Costco. I've got some phenomenal stocks in there, but Hood has been something extra special. So I really like it. I see the ATR coming down, which is good. That's always a sign of stability in motion, right? That sort of stability being more durable over time. If I see this kind of realized volatility, if I see it pointing up, I'm a little nervous, right? This is a sign that things are potentially going to keep going, right? Go sideways here for a bit, but then it starts going up again. So I want to see this start to dip even more and get into the twos, and I'll start to feel better about overall stability. So let's take a look at the options now. We can see this is the 30-day pricing in gold here. So you can see 30-day pricing. I'm going to take off historical volatility, not as important to us. So you can see it's kind of stabilized a little bit, not as low as it was in the fall, but this is a stock that's on the move. So I think this is respectably lowish. So I don't mind that. You can always put in your percentile and rank and kind of see where that lies. It's a stock where we're going to look at a trade in a moment here. You can see realized volatility falling off a cliff. This has been a very quiet stock lately. The IVR, IV percentile under that blend is at a certain point where I kind of like this. So I think you can kind of go for income type strategies. I think you can go for maybe a cash secured put sale. I would almost position in a turbo at this point because you're not getting a ton of premium. So you might want to use that to kind of generate a little bit of upside if you truly do like the name. If it's one of your sort of top 5 to 10 names, that's where you can start to bring in that combination in there. So let's take a look at since we'll be looking at a longer term play, we're going to look at something longer term, right? Don't look at 30-day if you're considering a 1-year option or 2-year option. It's going to give you an indication, perhaps, of sort of what's happening, in the near term, and that's going to sort of give you insight into the overall term structure. But we don't know for sure. So we look at, let's get rid of the IV rank percentile, so we can see that longer term option pricing is okay, right? We're way off those highs again. Again, if you've watched my videos, I don't put a huge amount of emphasis on the Vega risk per se for certain kinds of trades, for leap trades and things like that. Those longer term stock replacement plays. And I've given a good explanation that you could check out the video, my more comprehensive video on leaps, which I will post in the description as well. And as an end screen at the end of this video, you should see that as well. So we can see that the option pricing, it could be a little bit lower, but let's take a look at Market Chameleon. We can see the skew here. So really kind of flat. It's kind of interesting on this play. I'm seeing this actually in quite a few stocks lately. Very flat. No one really expressing any particularly upside view or downside view. no panicky views either way. So I think it's kind of interesting. The market, maybe that's sort of tells you that the market isn't really quite sure where things are going, right? We're sort of, you know, for really, really good news, but there's still things in the background, geopolitical, tariffs, et cetera, that are a big problem. So we're maybe in a place where the market just kind of doesn't know what to do. If we look at that longer term skew, if I look at like a June 2026, look at that. That's really nice. I mean, if you really are of the more aggressive kind of trader or investor, that's interesting. You've got sort of cheap upside, which I always find is one of the great opportunities out there. This is not advice, but when everybody's kind of focusing on being negative, sometimes they underprice the upside. So I think it's kind of an interesting thing to look at. You've got a little bit cheaper out of the money here. That's not really how I tend to do leaps. Sometimes I do if I really see some very, very big explosive potential. For something like this, I think I'm going to want to go maybe just a little bit more in the money. So why don't we do that? Let's take a quick look at the actual trade. Okay, so first, and if you download my 4-day challenge, which is really, really cool, really recommend it. You're going to see me talk about the MTI, which is my indicator that I teach in the program. Everyone gets that. So you kind of see we've kind of really come out of a very difficult period for the overall market, for Hood, of course, and we start to get these nice yellows and greens. So yellows are a little bit more like you're going to focus a bit more on certain kinds of income trades, which the course, the Crush the Premium course, kind of tells you exactly what to do, what strikes, et cetera, et cetera. So it's a bit more income-y type trades, a little bit more cautious. Here you start to get a little bit more aggressive. I like to see direction, right? So when I see direction of any kind, right, realized, implied, whatever it is you're looking at, direction should be meaningful to you. And I see things kind of improving and getting into yellows and then solid greens. We still have the fear gauge kind of factor down here, kind of holding things back a little bit. So I'd say this is a bit more in the income region for shorter term trades. But if you still really, really like the trade, as I said, I think you could kind of dip your toe in here, but really keep a bit of dry powder, because I think there's always a chance we could pull back into the 50s, low 50s. And so what I'd be looking at is, if you look out towards June 2026, I kind of like, again, you can see all this stuff in my longer term leaps trade video, and you kind of look at maybe something around a 47 or 50 strike. You could pick up one of those. So if I pick up, say, a 50 strike, that's going to cost me about $26 with the stock at $66. So you can see there's about $10 of time value on that particular trade. You're going to get a little bit more time value in the calls than you are in the puts. Right? That's one of the nice things about the cash machine trade. But if you're just doing a leaps trade, then you've got a little bit of time value on there. So you've got to kind of accept that there's a little bit of that Vega risk here, unless you want to go a little bit more in the money. But I think that's an okay trade if you think this does have significant upside potential. So I think that's a trade where you could, there are some targets on the street, 105. I think it could overshoot. I think it could actually do a little bit better over time. June 2026 is only 1 year. So if you wanted a little bit extra, you could go Jan 2027. That's going to give you just that little bit of extra time for this 2025 year to maybe sort itself out, which may take a little bit of time, let's face it. And that's going to position you with something that's going to have a little bit less decay and that time on your side, right? So you could go in to something like a 45, Jan 2027, 40-45. So to control 100 shares of Hood, you're going to have to spend about half as much there. And I think you could probably turn that into a 2-bagger there. And on the Jan 2026, I think you could probably turn that into, 2.5 to 3-bagger, three times your money on something like that. So there you have it. This is what it's going to look like. Of course, the long leap call is just a call. It just has more time on it, right? So you're going to have limited risk to the downside, which is always one of those nice features. If things really do collapse, you do have this limited exposure to Hood, and it's something that's going to act. It's about an 80 to 82, 83 delta, so it's going to act about 80 to 83% of the stock. So versus long 100 shares, you're going to get about 80% of that on the way up. But remember that delta is going to adjust as the stock goes higher. So eventually it's going to act like a 90 delta, 95 delta, very much like the stock. So the beauty of a leap to me is not leveraging up and doing 2 of these instead of 1. It's really kind of comparing it to a stock position and realizing that the benefit is to be able to get exposure for a lot less capital. And that capital you put aside, you can invest in something else, you can take a vacation with it, whatever it is you want to do, you are limiting your exposure. Sometimes, I'll do these trades for about 1/3 of the cost of buying the stock. That doesn't mean you can buy 3 leaps now. Now you're leveraging up. That is a completely different outlook and level of risk there, right? So I like to use leaps in the safest way possible, which is basically to create exposure with a very nice hedge and even a bit of a Vega punch. Like if the hood really gets crushed, you get a little bit of a cushion, not a lot, but you're going to get some cushion from the volatility expanding, and to have that cash on the side. So that's a really nice feature of a leap. So let's take a look at a cash machine trade. So I would be looking at, for those trades, if you watch the course, I'm going to give you a nice range of options expiries that I like to look at. It's generally between 35 and 60 days is kind of that sweet spot for me. And so I would be looking at about 2% of the value of this holding. And so by 2%, I mean, well, where's that extrinsic value? What am I getting here? If I look at 1%, it's about 66 cents. 2% is about $1.20. So I could probably sell a July 45, which is an in-the-money call. Why am I doing that? Well, I'm getting this beautiful combination, and I find a lot of people who come to me, especially more advanced age, where they really don't care as much about upside growth. They're really about turning stocks, their portfolios, into these apartment buildings that are just kind of paying you these rents, right? So that's really what they're focused on, and the nice juicy option pricing really gives them that nice benefit, that added yield versus risk-free rates that are going to give you very little, more than 3 years ago, but they're going to give you very little if you're on a limited income. You have a limited amount of assets invested. It's going to be difficult to move the needle. So this is where these kinds of cash machine trades could really, really kick in and give you both a nice cushion to the downside as well as that level of income that's not knock it out of the park. You're not going to make 2-3 times your money on this. You're going to be aiming for that kind of 2 to 4% a month for these kinds of trades. So you have to be more comfortable and understand that this is a more limited way of generating some cash flow, but it comes with that beautiful, beautiful downside hedge down to that strike, right? So if I sell these, I'm basically protected down to 45 plus the time value that I got, that $1.30, which is these are about $1.30 in time value. So I'm really protected down to about $43.50. And that's pretty nice for a stock that's trading at 66, knowing that I'm going to generate a couple of percent over the next little while is pretty good. Now, if you want to generate a bit more, you can move that strike up. So that's the cash machine trade for this that I'm recommending. So a little bit of conservative and a little bit more aggressive, although I wouldn't say the leaps trade is more aggressive in a sense that you're really sticking your neck out, but it is a higher level of capital. One contract of that leap is going to be, whatever it was, $2,500. This is going to be a trade that is going to give you just a little bit of a cushion while generating that time value. So hopefully you guys enjoyed that. A couple of trades for you to look at. I know it took a while to get into those trades. Tell me what you think in the comments. Let me know if you have any questions, if there are any stocks you'd like me to cover. And I'm going to be doing a sort of a more or less regular show on YouTube at some point soon. So look out for that. And make sure you like and subscribe and have the alert on for this channel so that you know when I'm going to be doing stuff and when the new videos come out. So everyone have an awesome week, and we shall see you in the next video.